when it came to this decision to hold snap elections in June, markets had interpreted that as increasing the odds of an orderly Brexit. How would you see it?
No, I think that's right. I mean, some commentators say it's because the Conservatives are doing well in the polls. The Labour, main opposition party, is still in disarray. That they're trying to gain more seats at the cost of the opposition. That's true, but I think more importantly, maybe even, is the fact that within the governing Conservative Party, there are different groups as well and different thoughts on how Brexit should happen. She belongs, from all we can see, to a sort of a more pragmatic group that she leads, and I think she's also trying to actually expand the importance of this group within the Conservative Party's MPs, and therefore get more flexibility to actually make compromises, because she understands she has to make compromises. Just to say, this is what we want, and the Europeans better submit to our wishes, that's certainly not going to work. So I think this is really the background, that she tries to really strengthen her hand, not only against the opposition, which has no clear pro-European or pro-Remain position to begin with, but in particular against sort of some of the more hardliners in her own party.
When you look at what happened yesterday, the British pound had a pretty big move.
Yes.
And I think that was surprising to a lot of people in markets, because they view Brexit as sort of being something that was triggered, and now we know the trajectory and it's going to happen. From the rating standpoint, though, if what happened yesterday indicates that perhaps there is still sort of a slack to be had in the markets in terms of the expectations for the effect of Brexit, from a rating standpoint, how do you assess the sovereign rating of England when it appears that maybe it's not just a simple sign it and let's move on?
Yeah, this is certainly not going to be that way. I mean, this is so complicated. Nothing at that scale has ever been attempted in such a short time frame as Brexit. So what is critical, I think, for a sort of a stable environment is that there is some sort of transition that can be agreed upon. How the current full membership will then over time lead to basically a detached relationship. Because it's not only trade, there's a lot of talk about trade, but that's actually almost the easiest part to solve. All the services that are traded across Europe, with the UK in particular, but also all sorts of other issues, from air traffic to education and university. There's a myriad of things that need to be solved. So you need time for that. And I think with this election in the bag, she might have a better position to do so. But there will be great uncertainty. It will be very difficult, and it's difficult for markets to actually price this risk, because there's no precedent on which you can compare it with.
Let's move on to the United States. We're going to be bumping up against our debt ceiling pretty soon again. Yes. Are you at all concerned that we're going to see a repeat of 2011, another showdown along those lines? Do you think the bar is higher or lower to a reduction of the U.S.'s credit rating this time around?
Well, in 2011, remember, we lowered the rating of the U.S. exactly around that episode.
Sure.
Because there seemed to be, I mean, there was obviously no cash crunch. It was just a political conflict that couldn't be resolved. Our current rating is on a stable outlook, AA+. So we would assume that it should be really doable in the summer to jump over that bar. I think it should be lying pretty low, in particular since we don't have the division of power between Congress and the White House we had back in 2011. And surely, the administration and Congress are not always looking eye to eye, but all things considered, it would be surprising if they were to let it come to this. So we expect that this will be resolved. Maybe it will be resolved with little time to spare, but I think it should be an easier task than it was in 2011.
Markets reacted very strongly in 2011 when S&P did make that downgrade. So what did you learn from that, and how are you applying that to this time around?
Well, actually the reaction of the market at the time, as you remember and kept reminding me in previous interviews, was actually that the bond rallied, which is totally expected. So it's to be expected, because if you have greater uncertainty, right, basically the money will flow into the asset that is the safest.
Treasuries.
And that's the U.S. Treasury, whether it's a AAA or AA+. So I think the markets, from what I can hear from investors as well, they take also the view that we shouldn't have a repeat of 2011, and that's why you see sort of also that the Treasury, how the Treasury has been behaving over the last couple of weeks. There's no indication of panic or anything like that.
Over the past year, investors have observed that developed economies are starting to take on emerging market-like characteristics, Brexit being one example, the election of Donald Trump being another. Do you agree that political risk is starting to appear in a material way in these developed markets the way that they were in the emerging markets?
I think that's the case. So if you look at many of the rating actions that we took in the developed world over recent years, the US, the UK, but also in the Eurozone, much of this was not so much based really on economic fundamentals, although that played a role in some instances, but really on what we thought is a political and institutional environment and governance structures that make predictable, effective policies less certain than they used to be. And you mentioned two examples which were not on people's minds. If you look at the elections coming up in Europe this year, there's great uncertainty. And I think this is a reflection of deeper divisions in society, which will make coalition building harder, which will make it harder to actually implement the forward-looking and foreseeable policies.
And